Big moves within the markets. We've seen the latest jobs report and it made for pretty interesting reading, certainly shifting the narrative around exactly what the Federal Reserve is going to be doing. And against that backdrop, we're going to be looking into exactly what to look out for with Friday's US CPI inflation report. So we'll quickly touch on exactly what the fallout is for that jobs report and then look into Friday's CPI reading. So first and foremost, as ever, we're going to look at what markets are anticipating for this release. And you can see markets expecting things to be relatively under control. 0.2 on the monthly for the core, 0.1 on the monthly for the headline. So more of the same. And in actual fact, even more of that narrative around inflation essentially being under control. Remember, we've got a new Federal Reserve chair that looks likely to be in the hot seat in May. Of course, we need to see him approved first, but Kevin Warsh essentially provides the potential for a more dovish outlook going forward, set against the backdrop of his hawkish past, potentially providing a narrative for the Federal Reserve members to get behind. If they've seen him in the past being very hawkish, they can, of course, get behind the idea that maybe now is the time to act. And in particular, what we need for that is weakness in the economics, so the jobs market, and weakness in terms of inflation. Now, we've seen the jobs report and we're going to see the inflation figures on Friday. Bearing in mind, the jobs report, in actual fact, saw a really significant beat to the headline number. Well, what we saw in terms of the headline figure was 130K. Markets are expecting something more like 60 or 70K. And we saw a massive revision to the 2025 figures of over 800,000 jobs taken out of the mix. And what's notable here is that whilst we saw that 800K figure being above what some had anticipated, it started off as the first revision around 900K. Then we saw people calling for it to, well, actually Jay Powell saying it's going to be closer to the 600K mark. And now it's coming higher than that at 800K. That provides the backdrop against which people can say, okay, how was that annual revision? And also how was the monthly metric? Well, the monthly metric was significantly stronger than most had anticipated. And if you look back over the course of the past year, you can see exactly how things have been shaping up for the economy. And it's not great, quite frankly. You can see that essentially it's been driven really heavily by education and healthcare. I think this is a really interesting report here from Justin Wolfers that really breaks down exactly what's what. So you could talk about strong numbers, but really, if you're looking in terms of the spread across different sectors, it has been very narrow, and there's many sectors that have been suffering. So from a Fed perspective, I'm sure there probably will be a feeling that they need to do more for a number of these different sectors. You can't just look at payrolls and say, well, as long as one sector's doing well, the rest doesn't really matter. But on the sort of face of it, that number for the monthly figure really did outperform, especially with the decline in terms of unemployment. In terms of inflation, bearing in mind, Warsh believes that we're going to see significant disinflation coming into play with the fact that we're essentially seeing AI that's going to come and take people's jobs. Yeah, fine. The jobs market might not necessarily look good, but we might get disinflation with it because it's going to be a lot cheaper for people to get or for companies to be able to get jobs done and tasks done in the future. So an expectation that down the line we see further weakness in terms of the jobs market. We had in the lead up to that jobs report seen commentary coming out from the likes of Kevin Hassett and the likes of Peter Navarro, both signaling the possibility of further weakness down the line because of the fact that we've got these policies when it comes to deportations and the like, and that provides a backdrop for weakness in the jobs market. Well, I would say that's probably going to continue from here on out because ultimately we do find ourselves in a position where AI is likely to start taking over in a big way, and people will start to substitute out employment for that technology. In terms of the inflation picture, the disinflation, we haven't necessarily seen a huge amount of it at the moment, but it certainly is at least on the downward trajectory. You can see we were in the sort of 3% in the midway point of the year. Of course, we saw that shutdown period, so then we saw this gap. And then we've seen it essentially drop down to 2.6, 2.7 on the core reading. You can see here that the sort of monthly figures at the bottom do highlight that the January figure from last year was pretty hefty. And so there's a possibility that we do see some disinflation coming into play for the year-on-year metrics as a result. So potential weakness in terms of the inflation metrics, and that's something that the inbound Fed chair appears to expect. Now, notably, if you look at Trueflation, they actually take a huge amount of data in the real world and try and crunch it to create their own inflation metric. You can see, whilst the BLS have reported 2.7 on the CPI number, you can see that theirs is just 0.74, with a notable deterioration in terms of both services and goods, as you see on this chart. And then also another segment of it I've seen that's notable is the housing market. Look, if you're essentially pushing people out the country, then you're taking some of the pressure off on the housing market. And so you have seen some of the weakness in terms of price pressures in the housing market ease. And there is a hope for Donald Trump that we will see more of that as we see inflation come down, allowing the Federal Reserve to be able to ease interest rates and taking the pressure and the burden off renters. An interesting chart here from Steno Research really highlights the relationship, historical relationship between that Trueflation metric and the US CPI. In actual fact, that points towards it really leading the way forward, and the possibility of further downside to come from here. So keep an eye out for whether we do see that disinflation. We've got a Fed chair that's expecting it. We've got, well, a potential inbound Fed chair that's expecting it. We have got the Trueflation metric indicating a similar kind of thing. And we've got a jobs market that is not necessarily super strong right now. That points towards the idea that we could see some pressure on prices going forward. Of course, the fear was really around tariffs, and some of those tariffs have either been eradicated or trimmed down. And much of that impact should have been and gone already now anyway, right? Because it's been some time now. So that means that the sort of inflation fears have eased somewhat. Nonetheless, certainly if we're looking in terms of the market pricing, this was taken around about that payrolls release. This is going to change. So certainly make sure that you're looking out for the latest numbers. This is from the CME group, the FedWatch tool. And so currently markets are pricing in essentially the first rate cut coming into play in June, and then the possibility of a second one at the back end of 2026. The caveat here is that, of course, markets have been taking this as a negative in terms of the possibility, or the jobs report as a negative in terms of the possibility of the Fed easing in the coming meetings, in part because whilst you could say that, okay, the annual revision was worse than expected, but then the headline number for the monthly payrolls figure was better than expected, but unemployment largely appears to be under control. Yes, we've got that sort of annual revision to bear in mind, but that's a pretty strong beat on the monthly, and it does embolden people. There is a feeling that Donald Trump's policies will be positive for the economy, but maybe it takes a little bit of time to come through, and certainly maybe there's a feeling that that could start to come through now. But the fact of the matter is, it does provide enough of a reason for the Federal Reserve to think maybe they can hold off for the time being. Of course, interest rate cuts are great, but they will be aware of the fact that if you continue to cut interest rates, it's going to start to lead to potential problems down the line. And I think, with this data, it becomes much more likely that they're going to hold off and see what Powell's successor does. Now, in terms of the market reaction, it really highlights exactly what the state of play is at the moment in terms of where people think this is going to go, because you can see that markets have essentially sold off the likes of the price of gold. You can see in terms of the price of the dollar index, that's it in positive light. So you can see that the dollar index has rallied, gold has dropped. You can see the correlation between the two when we inverse the dollar index. And there you go. So strength in terms of the US dollar in response to that jobs report, weakness in terms of the price of gold. That points towards people thinking that maybe the Federal Reserve are going to hold off for the next couple of meetings, and they'll just have to see exactly what happens with Warsh. Also notable that Warsh in the past has been very hesitant when it comes to addressing inflation, and therefore if we do see inflation on the rise, then that's the kind of thing that really could impact this further. So as things stand, the tentative response has been, this makes it less likely that we're going to see much from the Fed over the near term. However, I would say that Warsh would probably pay more attention to inflation. And so if we see inflation picking up in a meaningful manner, that would reiterate the moves that we're seeing right now. So weakness in terms of gold, strength in terms of the US dollar. But we don't necessarily know that that's going to happen. And certainly the true inflation relationship does point towards a possibility that in actual fact, we start to see inflation coming down in a meaningful manner, and AI should do that job as well. Remember, there's a lot of concern recently around software companies, right? The software sell-off. Why is that? Because essentially Anthropic's bringing out tools that can do a product or provide a service that these software companies providing. They provide it for a very high price. Well, AI can potentially do it for a fraction of the price. So AI is disinflationary by its nature, for sure. In terms of price action for gold, you can see we've sort of flushed lower, but we're getting these long lower shadows. I'm on the hourly time frame here. It does point towards a possibility that we're just going to see more of the same, right? So look at that, into the 76.4 fib. And so unless we break essentially the 5,000 mark, then this sort of intraday trend does still remain in play. If we break the 5,000 mark, then we're going to be looking for another one of these moves, right? So we're at this resistance level at the moment, which is your 5091. If we break through that swing low around 5,000, then you're looking for a wider, let's just get that in here. Then you're looking for the sort of wider retracements to come into play. But we need to break through 5,000 for that to happen. And certainly I think the inflation report should provide exactly that lead. In terms of the FX markets, the strength of the dollar, I've sort of paired it up with the pound. You can see here sort of pulling back quite sharply. Recently, the pound's been under a bit of pressure. The Bank of England likely to start to act in a more meaningful manner now, given the fact that they essentially have the clarity to be able to say they think inflation is going to come down to target by April time. And you can see here this rally set within this period of weakness points towards a possibility of a breakdown from here. So the move through 1363 gives you that double top formation. And certainly if we did see a strong report in terms of the inflation numbers on Friday, that would provide the basis for a potential move lower for cable. But that's if. And the caveat to that is if we don't see that, if we see a weak inflation report, then you've got the possibility of the opposite. You've got the possibility of further downside for the US dollar, and in which case I'll be looking at the Aussie dollar against the US dollar. Aussie doing very well, inflation a problem, rate hikes potentially coming down the line in Australia. So again, really I would sort of pick and choose according to what the numbers look like as to exactly what I was trading it against. And if you're looking for a weak US dollar, I'll be trading it against the Aussie. If I was looking for a strong US dollar, I'll be trading it against the pound. And finally, if we're looking in terms of the stock market, you can see the Dow has been a bit of a trusty one recently. I mean, look, the sell-off that we've been seeing in terms of the tech space really does highlight the benefit of investing in some of these a little bit more old school companies, right? I mean, we've, in the past developed talking about railroads and oil and gas and manufacturing and all this kind of stuff that down the line everyone thought, it's not about that anymore. It's all about tech. Well, I think we're rotating into a position where people think they at least need to have a decent amount of exposure to these sort of old school industries, in particular where you've got a Fed chair that is all about sort of Main Street and the development of the economy. You've got a government that really has been focused quite heavily on the idea of repatriating much of the manufacturing sector and the development of the mining sector so that they become a lot more self-sufficient. So all of a sudden, many of the companies within the Dow look attractive, and the likes of, say, the NASDAQ looks a lot more at risk because of the jitters you're seeing within the tech space that we saw at the back end of last year. We're seeing it once again at the beginning of this year. So we've rallied seeing a little bit of weakness here around that payrolls report, where people think, maybe we're going to see a more hesitant Federal Reserve. But essentially, I'm expecting more of the same, right? So higher highs, higher lows, most notably the higher lows. So any pullback, unless it breaks the 48460 mark, it looks like more of the same in terms of a retracement rather than a top for that market. But certainly US markets do look good, but it depends really where you're looking, because you can see some segments of the economy doing awfully. And at the same time, you can see other segments of the US economy that still fares very well. And I do expect, with 4.4 GDP at the moment on an annualized basis in the US, I do expect it to be a very strong period going ahead in terms of the US economy. But I also expect there to be periodic jitters within the tech space. And that's exactly what we've seen here around Anthropic. And we saw it around the Michael Burry short towards the back end of last year around valuations in the Mag 7 names. This is going to be a narrative that keeps coming and going, coming and going. And I think the more it comes and goes, the more people are going to get scared into diversifying away, whether it's regionally or whether it's in terms of sectors. And I think the benefactor of that would be an index like the Dow. So keep an eye out on the Dow. I think that's going to be a strong one going forward. I hope that's been useful. Make sure to like, subscribe, and follow for more. And yeah, keep an eye out on this inflation report on Friday. Certainly, we've got a Fed chair waiting in the wings, who in the past has been very hesitant when it comes to the inflation risks ahead. But now all of a sudden he thinks AI is going to resolve all of that. Certainly, trueflation points towards the possibility of disinflation, which could provide the basis for a much more dovish outlook from the Federal Reserve than many had been pricing in recently, when we saw those major jitters around Kevin Warsh's nomination. Cheers, guys.